If you're doing business in a UAE free zone, you have absolutely thought about VAT. It's a topic that's just full of myths and, honestly, some pretty costly mistakes. But today, we're going to cut right through all that confusion and give you the clear answers you've been looking for. So let's just get right to it and tackle the biggest myth of them all. You're set up in a free zone, which means you're free from VAT, right? It's what almost everyone thinks, but the answer is a hard no. And you know, that single misunderstanding can be one of the biggest financial traps in the entire UAE tax system. The reality is, well, it's just a little more nuanced than that. The real key isn't whether you're in a free zone, but whether your free zone is an official designated zone. Understanding that one difference is everything, and that's exactly what we're going to break down right now. Okay, so what exactly is the secret sauce? What turns a regular free zone into a special designated zone in the eyes of the tax authorities? Let's get into the nitty-gritty. A designated zone is, simply put, an area that the government has officially decided to treat as if it's outside the UAE for VAT. The easiest way to think about it is like the duty-free shop at the airport. You're still physically in the country, but when it comes to taxes on goods, you're treated like you're not. But, and this is a really big but, the zone has to meet some incredibly strict conditions to get that special status. And I mean, look at how specific these rules are. First, it has to be a physically fenced-in area. Second, it needs real security and customs controls, kind of like a mini border crossing. Third, it has to have solid internal systems for managing goods. And finally, the operator has to be in perfect compliance with a federal tax authority. If a free zone misses the mark on even one of these 4 points, poof. For VAT, it's treated just like it's on the mainland. Okay, so you've confirmed it. Your business is in an official, bona fide designated zone. Great. Everything's VAT free now, right? Well, not so fast. This is where we hit the most important rule of all, the huge difference between how goods and services are treated. This right here is the heart of the matter. If you're supplying goods within a designated zone, the transaction is generally treated as happening outside the UAE, so no VAT. But if you're supplying services, the rules do a complete 180. The supply is always considered to be inside the UAE, and that means the standard 5% VAT rate applies. This is the Great Divide, and it's the rule that governs almost everything. Let's put this to the test with a really common scenario. Imagine you run a marketing firm from your office in a designated zone. You land a big project with a client based on the mainland, say in downtown Dubai. Do you add VAT to your invoice? The answer is a resounding yes. You absolutely have to charge 5% VAT. It makes no difference that your office is physically inside the designated zone. Because you're providing a service, the law just pulls that transaction right back into the UAE for tax purposes, no exceptions. Now that we've really hammered home that split between goods and services, let's go back to goods for a second. Remember I said they're generally outside the scope of VAT. Well, that word generally is doing a whole lot of work there, because there's a massive exception that we have to talk about. And here it is. This is the game changer. That whole VAT-free treatment for goods, it gets thrown out the window the second those goods are meant to be consumed inside the zone. In other words, if you sell goods to someone within the zone, and they're going to be the final user right then and there, the transaction is suddenly brought back into the VAT net. Okay, so this brings up a good question. What does consumed really mean in practice? Let's say your business buys stock from another company, also in the designated zone, and your whole plan is to resell those goods. Have you consumed them? And the answer here is no. Consumption really means the end of the line for the product. So just buying goods to resell them, or even buying raw materials to manufacture something else, that doesn't count. In those cases, the supply stays outside the scope of VAT. It's a crucial distinction. Let's keep digging on these exceptions, because this is where a lot of businesses get tripped up. How about the absolute basics? You know, the utilities that keep your lights on, your water bill, your electricity bill. What's the deal with those? Yep, you guessed it. They're subject to standard VAT. The rules are crystal clear on this one. Water and any kind of energy are always considered to be consumed right at the meter. So even though you're in a designated zone, you're going to see that 5% VAT on your utility bills. All right, let's cover one last big exception. What about property? Let's say you buy, sell, or maybe even just lease a warehouse or an office inside a designated zone. How does VAT apply there? That's also going to be subject to VAT. The logic is pretty similar to the utilities. A building is consumed where it stands. But check out this interesting little twist. While the finished building itself is taxable, the raw materials you might buy within the zone to build it are not. See the difference? Those materials are seen as being part of a production process, not consumed on their own. Whew, okay, we've covered a ton of ground, from the very definition of a designated zone all the way to these tricky little exceptions. It can feel like a lot, so let's boil it all down to a simple final checklist. These are the things you absolutely have to know. Okay, let's lock this in. First, don't assume. Always check the official government list to see if your free zone is actually a designated zone. Second, just burn this into your brain. Services are always taxed. Always. Third, goods are generally out of scope unless they're going to be consumed inside the zone. And finally, remember that utilities and real estate are always considered consumed, so they get taxed. If you've got these points down, you are way ahead of the game. So, I'll leave you with this one final thought to take away. As you think about your own business, your own invoices, your own purchases, are you 100% certain you're treating these designated zone transactions correctly? Because getting this right isn't just about good bookkeeping. It's essential for staying compliant. Thanks for tuning in.